Hey folks, a very warm welcome to the brand new episode of FinMet Mondays. Sunil, great to have you back as always. Thank you so much for tuning in. Quite a volatile week for gold between hitting highs of 2086 to eventually returning back to lows of 2010. It caught a lot of people off guard. They weren't expecting such a strong jobs report. Definitely the question on everyone's mind is what the outlook for next week is, and maybe just even for the month. Where do you see gold heading towards?
So, like we discussed last week, we were looking at a breakout in the range, and that's what we saw. We were trading for so long between the 1960 and 2000 range, and we said it'll break out one way or the other. And I think what really drove the move up was a fear trade. Generally investors were worried that maybe we could have a situation where we would have inflation and then stagnation or recession. The data that you mentioned, really what it did is it showed that uh, recession is not coming anytime soon. And it also showed that the Fed is keen to continue to fight inflation. So both those two things went against the stagflation fear trade. And that's why you saw the pullback towards 2016. I think what you're going to find is that the the current support levels obviously are around 2000. I would say to customers who are looking for an opportunity to buy, and who are maybe short, they should look at buying on dips and closing some of their positions, and leave some positions open because we may see a break below 2000 if, let's say, further data shows that inflation is under check and that the economy is doing really well. So keep your powder dry, uh, close some of your positions, but be prepared for another move up or a move down below 2000 in case we break 2000.
Definitely. Even on the technical front, as I'm sharing on my screen here, we a simple check that mostly is done is to see from a much more long-term perspective, probably even taking a year's worth of data, where do the current price levels lie in terms of the Fibonacci retracement, which is a very popular tool. And one of the levels that we see here is the 78.6% Fibonacci retracement, which is somewhere around the 1983 range. So to your point, Sunil, which is, there's definitely room for correction. And technically as well, we see that this area right here is a strong area where we could see more correction if, let's say, next week's CPI data comes in, stronger. It is again going to motivate Fed, is again going to create a lot more confusion in the markets, and that's going to lead to a little bit more correction. So definitely this is something that, something just worth pointing out, that 1980 levels is where we would probably see a max correction towards before, like you said, a rally back again to 2050 to 2100 levels, right? Thanks, Sunil, for that. Also on, we also have, Indian imports, I think kind of going through an upheaval right now with the new UAE SEPA agreement. Um, what do you think that means for the pattern of imports going forward?
I think from FinMet's point of view, we're quite certain that a certain amount of imports that used to traditionally go through the banks in terms of LBMA bars coming in on an outright basis through nominated agencies, some of that is going to shift through the IABX and through the SEPA contract on the IABX. The last hurdle in terms of activating the SEPA contract on IABX has been removed this week. And so I think we'll start seeing active trading on IBX, and imports will take place through the IABX. So we would say to the jewelers that they need to be aware. Probably the window for getting TRQ is closed, but they need to keep an eye on the way that imports take place and see how they can benefit from the new channel of imports using the SEPA route.
Thanks, Sunil. Thank you for your valuable insight. Looking forward to meeting you next week as well. Till then, take care and goodbye.
Thank you.